and welcome to the market sector for Module 3. This one we're going to look at interest rate products. So this one will be fairly short. Okay, so first thing I do, I'm going to every now and again pepper in these new terms. So I'm going to look at liquidity in this one. And liquidity is essentially the volume of an investment changing hands, like how many times a day does something get bought and or sold. That's what liquidity is, and it creates tighter bid-ask spreads. It's one of the reasons that we want to use liquid products. So let's go over to Thinkorswim here. Let's type in, say, SPY, and let's take a look at a couple of things. Let's take a look at the volume and then the bid-ask spread. So the volume, number of shares that have changed hands in the last day. This would have been Friday as I speak to this. It's Sunday, the market's closed, but 77 million shares changed hands, okay, for SPY. Then let's take a look at the bid-ask spread of the stock and the options. So the stock here, the bid, it's sell at the bid, it's 235.09. The ask is 235.11. So if I bought shares, I'd buy them at 11, and if I changed my mind, immediately sold them back, sell them at 9. So I'd lose 2 cents. That's pretty good for changing your mind. Let's look at the now. Generally speaking, this will make a little bit more sense later, but at the money options tend to have wider spreads than out of the money options. So let's take a look at our old friend, the 30 delta option. So I'm going to change my column here to delta. And here we have a 29 delta put. It has a bid-ask spread of 4 cents, 170 to 174. Let's look at it on the call side. We have a there we go, 31 delta, 128 to 131. So 3 cent wide and 4 cent wide. Those are pretty good. Now let's take a look at something with low liquidity. Let's take a look at let's see if we can get some actual prices here. This will actually work. I actually kind of picked one at random here. Yeah, this will work. So this stock, I don't even know what it is. Hill-Rom Holdings, who knows what that is. 800,000 shares changed hands. Look at the bid-ask spread. It's almost $10 wide. That's crazy. I got really lucky with this one. That's why I hesitated a little bit. 64 to 53. So if I bought a share and then sold it right back, look how much money I would lose. My God. And then looking at the options here, spread $1.50 to $2.90. That's a $1.40 spread. We always want liquid products, okay? So first things you should look at when you look at buying or selling anything, the bid-ask spread of the stock and the bid-ask spread of the options. There's some more nuances to it. We'll talk later in the course, but that's a perfect place to start. So whenever I tell you these ETFs and things to look at, they're always highly liquid, okay? But we're going to look at that from now on. So let's take a look at TLT and TBT. So let's add those to our watch list. Just go in, type in TLT and TBT. TLT, currently $120 stock. It has a 12% implied volatility, and it has a correlation of minus 0.8. So it's minus 0.8. Oops, excuse me. There we go. Minus 0.8. And then TBT is a $40 stock, 25% implied volatility, and it has a 0.77. Okay. This one, TLT, represents 20-year plus treasury bonds. So if you ever heard of bonds, that's where you buy a bond to support the government. You essentially lend money to the government, and they pay you a percentage for that. That's a bond. This is not buying bonds. This is an ETF, so one of those exchange-traded funds, essentially those index-type products that represents the current value of those treasury bonds. And what does value mean? Well, it essentially is driven by interest rates. That's why these are interest rate products. So when the Fed, when they announce their interest rates, they're saying that the bonds that you can buy that's the percentage that you'll get paid on those bonds. Okay, so as they increase interest rates, you get paid more on those bonds. So TLT represents generally the value of the bonds, which is essentially driven by interest rates. As interest rates go up, what will happen is new bonds will be issued. So let's say interest rates go from 1 to 2%. New bonds will be issued that pay back 2%. When there's all those existing bonds that currently only pay back 1%. What will happen is, to make the supply and demand curve work, those bonds that were only worth 1% a minute ago become lower in value. That drives down the overall bond market. So essentially, bonds have an inverse correlation to SPY. Have an inverse correlation to interest rates. And as we can see here, to SPY, TLT has an inverse correlation too. It's a negative 0.8, so it's pretty high. So inverse correlation to the market. So what's the deal with TBT? TBT has a 0.7 correlation, 0.77 correlation to the S&P 500. Let's take a look at its chart. TBT, you see it's kind of flat here, then went down, then went up, and now it's stayed flat. Let's take a look at TLT, the inverse of it. Well, now we're getting really nuanced. Okay, so these ETFs that you have, these exchange traded funds, can do all kinds of different things. The TLT one tracks the value of the bond market. TBT tracks the inverse of the value of the bond market. So literally, if you think bonds are the bond market is going to go down, which means that you think interest rates are going to go up, you can buy shares of TBT, and when interest rates go up, the value of TBT will go up because it's inverse to the bond market. Now, you could also short TLT. What are some other things you could do if you wanted to short the bond market? You could sell a call, right? You could sell a call in TLT. That makes money when a stock goes down. You could sell a put in TBT. Why are we using more of these things? You just use all the tools that are available to you, okay? So I've shown you these. There are, of course, other ones, lots of other ones, but I've chosen ones that are very liquid. So let's go to TLT, go to the trade tab. Let's take a look at our numbers here. We've got it's about 7.5 million shares. Bid-ask price, not bad, about 85 cents, something like that. Let's go to our old friend, the 30 delta put and call. Let's change our expiration here. There we go. Here we go. We got some better pricing here. 29.86 to 91. So that's not too bad. It's a little wide, but it'll probably tighten up when the market's open. And then the 30 delta call, 95 to 102. So nice, tight, pretty tight markets there. TBT. Let's take a look at TBT. 1.2 million, so a little bit lower. But a pretty good spread. Look, it's only it's like 15-cent spread on the bid to the ask. And then if we look at our friend the 30 delta put, this one's a little wide, about 20 cents or so. 30 delta call, that one's a little narrower. Okay, what we're trying to find generally, now these numbers are skewed a little bit because the market's currently closed. Okay, they'll adjust when the market goes out. But in terms of liquidity, we're generally looking for stocks where the shares, that was the item at the top of the screen in Thinkorswim, you want to like above, at least above 1 million shares per day. Generally, even higher. The higher, the better. And then we want the bid-ask spread to be tight. And this really matters on the options more than anything. We want to try and find a bid-ask spread which is less than 5 cent wide if possible. Okay. But I'll reiterate these things time and time again. So this is the bond market. Tends to be inverse to the there we go, inversely correlated, excuse me. Tends to be inversely correlated to the general stock market. And anything that's not, doesn't move with the market is good, because that means we can make money on days when the market is down. So add TLT and TBT to your watch list. Go ahead, start selling some puts and calls, or do some covered calls, or do a strangle if you want in TLT or TBT. Just continue to add those positions. See you in the next video.